I'm riding with Elon. And what does that exactly mean on this stock analysis channel? Does that mean I'm buying Tesla? No, it means I'm riding with his economic analysis and his analysis of Tesla stock. He's obviously said before that the stock is very expensive, and he thinks the stock is going to be one of the most valuable, if not the most valuable, stocks in the world in the future. However, you have to also deal with the near-term consequences of reality, particularly the environment we're in, where the Fed is seeking disinflation, not inflation. Inflation is very good for stocks. We obviously saw that prior to the Fed tightening, and we have, over a longer-term time frame, seen the opposite of that as they've engaged in QE, or QT rather, not QE, as they've engaged in decreasing the money supply. So Elon said it best. Increasing interest rates is like brakes on the economy. And that is true. And that is what we're seeing in the numbers. And I'm not talking about the numbers today, where there was a strong correlation between 0-day to expiry call option buying, with the most traded contract of the day being 412 SPY calls. I'm not talking about that kind of numbers. What I'm talking about are the Target numbers, are the Home Depot numbers, are the Tesla numbers, the numbers that are indicating that the economy is weakening. And I simply don't think the bottom is in. It might be. But here's why I don't think the bottom is in. Because that bottom came on a hotter than expected CPI. After that hotter than expected CPI, we got a Fed dot plot. Why did we bottom, allegedly? And just the S&P, the index is bottomed on that. Mega cap tech did not bottom on that October 12th low. That came at the turn of the year. Just like the top came at the turn of the previous year. Seems a little too easy to me, but whatever. We'll say that for another day. Anyways, hotter than expected CPI, October 12th, market bottoms. Well, why does CPI matter? CPI matters because it allows us to price in our expectations for the Fed. On that October 12th CPI, the market wasn't pricing in 5% interest rates. As a matter of fact, the Fed in December later put out a more hawkish dot plot than they had previously, and in March put out an even more hawkish dot plot than they did in December. So if the market decided to bottom, saying this is peak inflation, this is peak Fed, it's going to come down, as we know the market has been expecting an aggressive decline in inflation, although that's not occurring in core, why hasn't it adjusted to the fact that the Fed has gone more hawkish? I'm not so sure, but we are seeing some signs that at least the bond market is slowly starting to come to reality. And if we can put this 0-day to expiry, that's what it was today. In my opinion, based on what I've seen, I've been looking at everything. I've been trying to find answers. That's what I'm seeing. Debt ceiling negotiations. What happened with that? If you know something that happened with regards to that, put it in the comments. Nothing happened with regards to that. I think most people expect it to be settled, but it's not settled. So if that's going to create some volatility, if that's going to create some trading, I don't know. It might happen, but it wasn't settled today. That's not what today was about. Maybe that is what stopped the initial decline, because it seemed that initial decline, the rise in interest rates, at least in the 10-year and the 2-year, it was at the high of the day at that point, coincided with the announcement that Biden was going to speak, and then that speech was literally nothing. It was literally nothing progressive. There was no shared negotiation. It was literally nothing, okay? So I don't think the debt ceiling had anything. McCarthy's saying if the Democrats come to our terms, we can have a deal. I think everyone knows that. But it doesn't seem that the Democrats are doing such. They probably will in the end. We'll see what happens. But it's not looking good. And we know tensions have only gotten higher and higher. This has created problems in past debt ceiling situations. This is probably going to be the most extreme debt ceiling situation ever. That is my assumption. What that means for markets, rather uncertain. But I'm trimming in some areas, particularly my exposure to longer-term interest rates. I was short, still am somewhat short longer-term interest rates. I'm covering those because I think there is going to be a flight to safety. I think there is going to be fear that builds up a little bit, at least, around the debt ceiling situation. We're already seeing what's happening with U.S. government credit default swaps, now priced higher than mega cap tech credit default swaps. And the fundamentals are deteriorating. Target, yes, they beat Wall Street expectations, but they said that April was weaker than March and May was weaker than April, and they expect weakness to continue. They also expect, or see, and expect to continue to see, lots of shop theft. That indicates higher crime, which is correlated with recession and other tightening situations. So I'm rolling with Elon, who said he expects lots of bankruptcies. That's what he said. Lots of bankruptcies. We've seen a few, but we haven't seen the full flight of that yet. So I think worse is coming. That I feel very confident in. I don't feel confident or good about the market moves like today. I think that is speculation. That is hope. That is buying panic. And I just don't, I don't buy it. I don't buy that kind of behavior. I'm sticking with the fundamentals, which I expect to deteriorate. NVIDIA's adding another year worth of revenues, not year worth of earnings, year worth of revenues today. And this is happening like every single day. It would be one thing to have like a few days of this kind of stuff. That would be one thing. But it's been all year. And executives at that company were selling the stock way lower. And the company itself filed to sell stock way lower. And they don't need to sell stock. They pay a dividend. If they needed cash, if that was actually a concern, they were trying to raise or conserve capital, which is what you do when you sell stock. You sell stock because you need capital. And that's the opposite of a buyback, by the way. That's like negative for the share price. You would just slash the dividend. That companies do that all the time. That's a thing that happens. But they didn't do that. They diluted shareholders. So it's been frustrating for me. We're still up today. We've had a very good last couple weeks or so. We've shifted our option strategy. We have stocks like PBF doing very well for us. And I still like that stock. We're currently at lower gasoline inventories than we were last year. And oil is weak. So I expect that company in particular to be very strong. But it's down. It's down. This is a crazy market in my opinion. So I'm just doing the best I can. I'm really just doing the best I can. I'm sharing with you the best analysis I can. This is what I'm doing. This is what I'm thinking about. This is just a stream of consciousness essentially. And this is what I'm seeing. So yes, a day like today, very puzzling. It definitely makes bulls have to question things. I'm setting a number in which I'm going to question things, and that's going to be something like 417.85. Why do I say 417.85? Because the highs of the month were 417 and change. I believe it's like 417.67 or something. I'm still optimistic from a short expectation person's perspective that there's still a head and shoulders pattern forming. I point to the very end of the year rally up to something like December 17th. Very similar behavior. We saw one last burst, and then we just saw gap down until the end of the year. And I thought that was going to go to new lows. That's what I thought was going to happen when the Fed put a more hawkish dot plot, which they have since made even more hawkish. And since mega cap tech earnings have either declined or decelerated significantly, but that's beside the point. Anyways, I think there's some upside catalysts that we got to have on our radars this week, particularly Powell and Bernanke. Bernanke being the Fed chair during the financial crisis. Why is this important? Well, what bigger collab could you want? I mean, the '08 financial crisis Fed chair and Jerome Powell doing their first interview, we'll see what it is, thing together in a very long time. There's definitely going to be a lot of attention on this. I listened to CNBC all day today. Didn't hear this mentioned once. Maybe that's a good thing. That probably is a good thing, because when things get mentioned too much, it causes stuff like we've seen today. Anyways, we know what the Fed has said in the last week. They are on the hawkish end. That's where they're leaning. If it wasn't that, you'd be hearing a lot more talk about a pause. And we're not hearing a lot more talk about a pause. If anything, we're hearing a lot more talk about the possibility of additional rate hikes and the termination of rate cuts this year over the idea of pausing. And the Fed wants to communicate very effectively. They've done this the whole time. That's why the FOMC meetings outside of the dot plot haven't been very big surprises. Nobody's really been surprised by a rate hike move. Why? Because they articulate it very well. They're very calculated in this. And I think they're calculating and inching towards slowly a rate hike at the next meeting. They don't want to deliver a surprise. They haven't really delivered surprises. Yes, in the past, if one has talked hawkish, it has moved the markets. We haven't seen that this year at all whatsoever. But this talk is calculated. And there are some members who think even more than one. We'll see. That would be obviously data dependent, which they're also saying they're going to do. But this Fed, Powell, and Bernanke thing will be interesting. I don't know what's going to come of it. I could be wrong. It might not be interesting. It might be a whole big nothing burger talking about, bank capital requirements or something like that. But Bernanke wanted to bring down the balance sheet. He did. Powell wanted to, she didn't. Powell wanted to bring down the balance sheet, is engaging in QT, raising interest rates at the same time of running off the balance sheet. That hasn't really happened. The Fed took a very long time to raise interest rates after the previous crisis. They did then end up doing it and did end up doing a little bit of QT, running off the balance sheet, and it caused a 20% decline in the market in like a month or two. So we are doing more than that. We are at a very extreme situation of QT, and it led to a very tough year last year for the market. And we're still doing that. If anything, we're accelerating that. We're doing more of it. We're doing higher interest rates. So it's a very peculiar market, very strange. We have NVIDIA adding a year worth of revenues to its market cap. Not earnings, revenues. It's just crazy. It's just I can't get behind it. I can't do it. So we will see what happens. That's today's video. And until next time, peace out.